The video is only your privilege, so I'm going to switch it off. ठीक है?
I understand.
ठीक है.
But I'll be presenting a PPT. So
Yeah.
again, it will be
Yeah.
a small window.
Okay.
Sir, we are good to go.
Yep.
A very good morning to everyone. So we all know that the latest amendments are really like when we are looking into the amendments, there are a lot of issues coming up because of the amendments. So we thought of taking a session on the issues in TDS, including the latest amendment. And we thought that we should call Shelar Mama. So I call Pramod sir as Shelar Mama. Sir, if you remember, in January 2020, you were there and Tanaji movie was just released. So from Pune camp, we call Pramod sir as the Shelar Mama of Pune camp CP study circle. And we are really privileged today that Pramod sir accepted our invitation and he's here with us. So on behalf of Pune Camp CP Study Circle, I welcome you, sir. And I know you need no introduction and I directly request you to begin with the session.
Thank you. Thank you, Chaitanya. Well, when this particular topic was thrown open to me, it was talking about the issues in TDS, and I was really wondering that now TDS section is almost settled, and what kind of issues that can come up for discussion. But then subsequently, I realized that yes, latest amendment is the real issue, because we see that a lot of amendment has taken place in last 2 years. Like I'll be referring amendment which are affecting from 1st April 2020, because there are a couple of amendments which are effective from 1st April 2020, then of July 20, then October 20, then April 21, then July 21. So you will find lots and lots of amendment, and probably we'll have to really see that what is the purpose of this particular amendments in TDS, whether it is merely a purpose of collecting the tax or it is something else, and that will be very interesting study as far as today is concerned. So probably the issues which may crop up in a discussion will be addressed wherever possible if the section is clarifying that. Otherwise, when I will have to wait for the clarification to be issued from the CBDT. So with this background, let me just begin with the amendment which has taken place, and I'll be going chronologically in a section manner. So the first amendment, what I could see, of course, applicable from Finance Act 2020, and we are all aware that earlier we had a regime of DDT, that is dividend distribution tax, and that regime was there for quite some time. As such, we are aware, and it was a very convenient regime. What we always thought of, that technically the DDT was being deducted by the company directly, or not deducted, directly paid by the company, and this entire income what was being received by the recipient was completely tax free. So it was not a case of a dividend getting tax free as such, but it was a case that tax was collected at source in the form of DDT, and the amount was then distributed to the shareholders. But now somehow that particular practice has been done away with effect from Finance Act from on 1st April 2020. And now again the old provisions of Section 194 dividend provisions which were there are brought into place. And we are aware now, yes, if at all we see these provisions, then it says that the TDS rate is applicable is 10%. It is effective from 1st April 2020. So all the companies now finalized 2021 accounts. Of course, now dividend distribution will be this year, if at all. Then obviously these TDS provisions are applicable even to private companies also. And it has replaced dividend distribution tax. Then of course, all the payment made to resident person, it will be covered. There is an exemption limit of 5,000 rupees. So we'll have to really be aware of that. And there are certain exemption provided for certain insurance companies or insurance, and of course to certain classes of business trust by a special purpose vehicle. Now, as a matter of fact, the important part which we must remember, the definition of dividend given in this particular section also include 222E section, and that is a very interesting understanding that one will have to really understand that if at all any such amount which has been paid, which can get covered under 222E, then probably it gets exposed for deduction under 194. So forget about the recipient, whether he's showing that income or not. But technically speaking, now if at all such advances are given, then the care has to be taken by company that what exactly the nature of that advance or loan or whatever, which may fall under 222E. And that in that case, the obligation is on the company to deduct the dividend. And then it becomes a very complicated aspect, because for the simple reason that if this 222E gets triggered, then obviously there will be implication from the recipient point of view. But from the company point of view, again, now there will be implication that there is a violation of 194 section, and then there could be some certain consequences in terms of interest and penalties. So first section which I thought we should discuss is 194, that is dividend. And I feel all of us are aware and we should take care of that particular section. The next section, what I found amendment was in 194A. Of course, this particular amendment, it's not amendment, technically speaking, it's a development what I thought I should bring to your notice. And that particular amendment is in the context of TDS. That is, we are all aware that cooperative society, like cooperative bank, whoever is cooperative bank, and that particular cooperative bank who is paying interest to cooperative societies. Now, the issue arises that this particular understanding of cooperative society as given in section 194A, and it was said that by virtue of section 3, subsection 5, cooperative society who is paying interest to its member, or cooperative society paying interest to another cooperative society, then there is an exemption under 194A. But now, by virtue of this 194A, by virtue of this judgment of Todgar's Cooperative Society, they are clarifying that this particular cooperative society term will not include cooperative bank. So suppose if at all any cooperative society pays interest to cooperative bank or vice versa, then there is a possibility of 194A getting triggered. So one will have to really be aware of that particular development. Then as per section 310, there is another relief which has been extended to infrastructure debt company. And these infrastructure debt companies are something to whom this particular relief has been extended. So that is the only amendment which is reference to 194A. Then interestingly, we have amendment in 194C and 194I, that is in the terms of specified persons. And in specified persons is something, meaning has been changed. Like earlier, we were aware that this particular exemption to individual and HUF, like individual and HUF, whose accounts are audited in the previous year, whose accounts are audited under 44AB, either under clause A or under clause B, then they were not supposed to, if at all in previous year they are not audited, then this particular provision of 194C, 194I were not made applicable to them. However, now interestingly, they have changed this particular clause and they have replaced the turnover limit. And now they say that for business it is 1 crore and professional it is 50 lakhs. So now it is not, there is no reference of 44AB per se. And this change has got a meaning, definite meaning, because now we are aware that under 44AB, we have been told that there is an amendment whereby if at all you are dealing in, if your entire business is through banking channel, that is the cash transactions are less than 5%, then earlier the limit was 5 crore. Last year we have enjoyed that limit of 5 crore, and this year it is 10 crore. So you don't have to get your accounts audited under 44AB. You can declare that under 44AD. So obviously now, last year, whoever we have done that exemption, we have taken that exemption under 5 crore category, that we have not really done the audit. But as far as the provisions of section 194C and 194I is concerned, they say that the moment your turnover exceeds that particular limit, obviously you have to deduct the tax. So now one has to be very careful that it is not a per se exemption for each and every category. The exemption is only for those categories who are maintaining the account, maintaining the entire transaction through electronic media. So obviously that electronic media was a supportive aspect for that particular section. But now here, as far as 194C and 194I is concerned, they have changed the definition. And now, although you may have not carried out the audit because you got an exemption, but still you will have to get your accounts audited. Now the issue will arise that what happens to 44 AD cases whereby there is a limit of 2 crore, and whether in that case, just because there is a 2 crore limit and 1 crore is a and profession 50 lakhs. So if at all we have gone by the presumptive taxation, then whether this particular section will get triggered still, because you are not maintaining books of account, and then whether it is obligatory on your part to maintain the books of accounts. Now here this is a very ticklish issue, because especially we are talking about the cases where turnover is exceeding 1 crore but it is less than the specified turnover of 2 crore, or otherwise 5 crore, because for 8% 8% and 6%. So in that case, whether it is obligatory on the part of the assessee to deduct the tax. Now if you go plain simple text understanding of these two sections, then obviously one will have to really deduct the tax, because it has only given the turnover limit of business as such. Now the issue will arise that what happens to disallowances, because disallowances and allowances is something which we really talk about while computing the business profit. And now under presumptive taxation, when we talk about making any disallowance or allowance, then obviously one will have to compute the entire income in the manner it is provided. Now, as far as section 28 is concerned, which talks about profits and gains from business and profession, and whereas section 44 AD or ADA talks about a presumptive taxation or fixed profit, irrespective of anything, and it presumes that all the allowances have been allowed to you, or all the expenditure has been allowed to you. So in that particular case, whether this will have any implication, that will be a matter of interesting. But it, of course, matter is arguable, but it is litigation prone. That definitely one will have to be very careful on that aspect, that because the now turnover limit is 1 crore and 50 lakhs for business and profession. So obviously one will have to take care that whenever such situation arises, to an extent possible, because there is no audit, there is nothing else, but obviously one will get caught by this turnover limit criteria, and everything is now technologically controlled. So obviously your turnover will get flashed everywhere. Now also we understand that system captures your turnover and accordingly initiates the various proceedings accordingly. So one will have to be very careful about this application of 194C and 194I in that particular case. The next is about 194N. There is TDS on cash withdrawal. Now, as far as generally when we read this particular section, it has been said that it is applicable to banking company or a cooperative society engaged in business of banking and post office. And amount of the aggregate of amount, that is whenever any person, any particular account, there is a withdrawal of rupees more than 1 crore, then you have to deduct, they have to deduct the tax at a rate of 2%. And this is made applicable from 1st July 2020. And there is no, of course, there are certain exceptions provided. There is any payment made to the government or banking company or cooperative society engaged in carrying the business of banking, or a post office, any business correspondent of a banking company or a cooperative society functioning as per RBI guidelines, or white labeled automated teller machine operator. So there are certain exceptions which are provided from this particular section, and this particular exception talks about excluding this particular category. Now, one issue which has arisen in this particular context is whether a cooperative bank which is holding an account of cooperative credit society, whether they should deduct such tax. Is because the wordings are very tricky, and one will have to understand that. Like this wording exactly used is not, it's applicable to cooperative, it's applicable to banking company, and further it says it's not applicable to cooperative bank per se, but it said that cooperative society engaged in the business of banking. Now, this particular terminology had a lot of discussion prior also, when ATP benefits were extended or ATP benefits were withdrawn. Like we are aware that section ATP was talking about giving 100% tax relief to a banking company or to a cooperative bank. And that was a wording which was ATP 21A, which talks about that any cooperative society which is engaged in the business of banking activity, will its 100% profit was treated as deductible. Subsequent to that, right from 2007, we have seen that there is insertion of ATP 4. And by virtue of ATP 4, it said that this particular provisions of this particular section will not apply to cooperative bank. Now, the issue has arisen that it says about cooperative bank. And now, if at all, it was alleged by the department that now cooperative credit societies are cooperative credit societies who are actually engaged in the business of banking, because they are a cooperative society and they are not, although not registered as a cooperative bank, but they are engaged in the business of banking. Now, there, of course, successfully one could argue that no, that is not a purport of the section, because ATP 21A is divided into two parts technically. It talks about a cooperative society engaged in the business of banking or who is providing credit facilities members. So it was argued that as far as the cooperative banks are concerned, they were covered under cooperative society engaged in the business of banking. But then the second part who are covered was that who is providing credit facilities member, that was a credit cooperative society. And accordingly, by accepting this distinction, the courts have taken a view in favor of cooperative credit societies. However, the catch is next. The next catch is that suppose any cooperative society, now it says that exception is provided to any other cooperative society engaged in the carrying of business of banking. Now, for example, one simple understanding that cooperative bank keeps the money in another cooperative bank, probably there is no issue. But now a cooperative credit society keeping a money in a cooperative bank, probably there will be issue which arises, because if at all in the beginning we say that this particular cooperative society engaged in the business of banking has to be understood and restricted to cooperative banks only, and it will not apply to cooperative credit society, then obviously we get caught in the second exception part, which says categorically says that cooperative society engaged in the carrying of business of banking again. So obviously, if we take a meaning there that cooperative credit society is excluded, so here also we say that the meaning has been restricted only to cooperative banks and cooperative credit societies excluded. So if a cooperative bank has holding a deposit of credit cooperative society, and if they withdraw anything about more than 1 crore, which is a very common phenomena, now cooperative bank will have to deduct a TDS as per 194N from cooperative credit societies such withdrawal. Obviously, on a practical term, when this advice was asked, obviously it was opined that they must deduct the tax because there is a mechanism available to cooperative credit society for collection, for asking for the refund of that particular, because they are entitled otherwise also for ATP 2A or ATP 2D, but then they're entitled for asking for the refund. So there should not be any problem as such. But interestingly, now this particular situation, the purpose of government will be that they will also get a data of all those cooperative credit society who are withdrawing huge, because that was the one of the area which government was also concerned, that cooperative credit society, through the medium of cooperative credit society, a lot of money has been channelized and used, and it was not getting exposed to tax. But now such withdrawals will definitely highlight that particular cooperative credit society that who is regularly withdrawing such a huge amounts, and obviously they will also understand the volume of transaction what they are each cooperative credit society carrying out. So maybe a small cooperative credit society may not have that particular problem, but a large cooperative credit society will definitely we have to be on alert and be aware of that this kind of transaction, because whenever they are withdrawing such a huge cash, obviously they are distributing that cash to its members. So obviously they will have to maintain such particular record to really justify that particular cash withdrawal in a time to come. But then yes, this was the issue, because many times certain advices were given that cooperative credit society you need not deduct the tax and all such things. But I strongly feel that yes, this section has been clearly drafted, because if they wanted to use the term cooperative bank, they could have used cooperative bank, but they have not used that particular word cooperative bank. So obviously one will have to be aware of that. Now, secondly, as far as 194N is concerned, all your large taxpayers, especially those who are making payment in cash of salaries and all those things, if it is now most of the places it is now controlled, but if at all they are making such withdrawals as such, then definitely now they will get exposed to this particular 194N tax of a rate of 2%. And especially once this get tax exposed, again, as I said, the purpose may not be the collection of tax as such per se, but the purpose is to know the database, because technically speaking, another issue which has really arisen in this particular 194N is about there is no income as such. So if there is no income as such, there should not be any, because then there is no withdrawal. So there is no question of 40A, 1A, all that kind of aspect. But as a matter of fact, can this particular 194N levy really sustain? Because all the other sections are there, which are in the context of income chargeable to tax. Like everywhere we find that income has to be chargeable to tax, whereas 194N, there is no such income concept. It's only my own money I'm withdrawing. But then again, as we say that yes, government will justify this particular aspect from that we want to have a proper control. Like we remember that earlier we had a tax called BCCT, that is Banking Cash Transaction Tax earlier, and then it was also to know that what exactly amounts are getting withdrawn. But that particular tax ultimately was omitted, that particular provisions, and now this particular new TDS has been introduced, 194N. We'll have to see how effectively they will be using on that count. Then much celebrated, so-called celebrated section by like in a section, finance minister has categorically said that they have given a benefit to specified senior citizens. They don't have to file return of income, and there is no botheration. And that was a announcement, and one really felt that yes, it's a very good measure what they are really doing. But technically, one realized that this particular aspect, when they actually we saw the provision, we realized that the provision is very sort of a limited implication as such, because if at all you see the conditions under which this provision exists, first of all, it talks about that basic exemption of 5 lakhs and TDS at 10%. But then it talks about that it has to have a specified income only. So every bank, what they will refer, that you have to have only pension income and any interest kept out of that particular, in that particular bank, any deposit kept and any interest received. So only two types of income, pension and deposits. So only that particular amount you are not exposed to tax. But then you have to give that clarification or sort of computation to that particular bankers. And on the basis of that computation, bankers will decide whether they have to deduct a tax or not. Or if they come to conclusion that tax has to be deducted, then they will deduct at a rate of 10%. So irrespective of any amount. So obviously, normally all these senior citizens have a tendency of dividing their money into different banks and all those things. So for such type of people, I don't think that this particular provision will really help. Or even if they have some share investments or any other investments or mutual funds, then technically, I don't think they'll be able to take any advantage of this particular provision. So it refers to very small class of society probably, and I don't know whether this will really benefit the real senior citizens who are actually, because as it is, they are not taxable as such. But now, technically speaking, if they don't provide the data, bank may deduct the TDS at a rate of 10% and so on and so forth. So this particular provision, although given with certain purpose, but the way the restrictions are put up, I believe it will be always an issue that whether it will really benefit the real senior citizens. And especially this specified senior citizen, they have changed the definition. They have made it 75%, 75 years of age. So specified senior citizen will be defined as a 75 years of age for that purpose under section 194P. Then we have this, of course, we'll be dealing with the details of this particular section 194Q, but one of the most controversial section initially when it started, and now there are clarifications which are coming up. But on a plain, simple understanding of 194Q, one has to understand that it has been effected from this month, 1st July 2021, and introduced by Finance Act 2021. Now, this particular section is applicable to any assessee who is a buyer. Now, buyer has been defined to say that buyer is a person who is buying the goods. Now, it says that TDS will be deducted 0.1% on value of goods purchased. So, TDS has to be deducted at the rate of 1% on value of goods to be purchased, and 5% in non-PAN or other cases, that is 206AA or 206AB. Now, this is also one of the amendment which will have to consider in detail, which we'll definitely consider. Further, it says that there is a threshold limit of 50 lakhs in a financial year. Now, there are differences here. The total threshold limit is purchase of goods. So it is by virtue of whatever amount you purchase. If it exceeds 50 lakhs in aggregate in a year, then you have to, this particular section gets triggered. Then it talks about TDS to be deducted only on value of goods in excess of 50 lakhs, and services are not included. So if at all somebody is providing services in that context, and that is not included here, it has to be deducted on value of goods in excess of 50 lakhs. Now, as far as requirements are concerned, it talks about purchase of any goods. Means there is no bifurcation of capital goods or personal goods. So even if you buy a capital goods like machinery or anything, still it will be applied, and you have to deduct the tax on that particular from buyer's statement. Then seller has to be resident in India, like the person who is selling this particular goods. So he should be resident in India, and he only has to deduct the tax. And value of purchase to exceed rupees 50 lakhs in financial year, and buyer's sales, etc. Now, another condition is says that buyer's sales of business should be more than 10 crores in previous financial year. Now, again, we are told that yes, now they are going to introduce a verification window whereby you can confirm that what was the turnover of that particular buyer, because last, and that also of a previous financial year. So as a matter of fact, as a good practice, one should advise their client that whoever the big suppliers are there from their side, from their client, you should intimate that what was your turnover in previous financial year. So if you intimate that, probably the most of this TDS applicability will go per se. If at all you are having a clients who are SMEs and whose turnover was less than 10 crores, and if they intimate on suo motu basis that this is our turnover in last year, so please do not deduct 194Q. Of course, there will be implication other way around, which we'll see independently. But then at least you can come out of this 194Q as such. Then payment by buyer and TDS by buyer on credit or payment. So earliest point of time, just like any other provisions of TDS, it also talks about that you have to deduct the TDS at the time of credit or payment. So whichever is earlier. So even advance payments are covered here. So therefore, we have to be very much aware of that. And also applicable for suspense account, like if at all anything amount is created, just like what we have in another provisions of 194 or 194 various subsections. So we'll realize that even you credit payment or suspense account, that will get covered. Now, as far as their exemptions are concerned, there are certain exemptions provided under 194Q. And one is exemption that is which is liable to TDS under the other provisions. So if at all there is any other provisions, specifically we'll be dealing with that is 194O, again a very important provision. So in that case, 194Q, there is an exemption. Then liable to TCS under 206, all provisions excluding 1H. Now this is very interesting. Rather, this is the area where people were really having confusion that what kind of which will prevail, because both the provision work exclusively. So that interplay we'll also discuss. And there are exemptions for certain specified persons. So they will be specifying that in official gazette there are certain capital gain transaction, and there is no such exemption of individual or HUF buyer. So in respect of individual HUF buyer, there is no such exemption. Still, if at all it is fulfilling the criteria of 50 lakhs and 1 crore or 10 crore, then they'll have to deduct the tax on that. Then of course, buyer has been defined. We said that turnover having 10 crores in previous financial year, purchase exceed 50 lakhs. And he's not a notified person. So there's exemption from TDS. So all those cases, we have to deduct the tax under 194Q. We'll be dealing in the detailed manner the issues and the clarification which has been received recently by 25th of June circular. We'll be dealing that separately. Now, interestingly, one more section which has been introduced from 1/10/2020, that is Finance Act 2020. And again, as I said, this is payment by e-commerce operator. Basically, there are a couple of parties which are defined in this particular e-commerce operator. And that is, one is an e-commerce operator per se, and e-commerce participant is another party. And there will be third party, there is a buyer. Now, typically to understand this particular arrangement, we must understand that is there are e-commerce operator like Amazon or so many operators, Mitra and Myntra, and so many operators are there. Now, what happens is that many parties who want to sell their products through this base, for this e-commerce base, they approach this e-commerce operator and then they put up their information of goods on that portal. And then whenever party buys, the buyer buys, ultimate buyer buys, he will have to place the order with that e-commerce operator, say suppose Amazon, and then Amazon will collect the money from you, and that goods will be delivered either by that person to you or that e-commerce participant, or it will be delivered by Amazon, and you will get the goods, and e-commerce operator will settle that amount, whatever they have received, they will settle with the e-commerce participant, that is who are the supplier. Now this particular 194O provisions are for that category, that is Amazon will collect the payment, and while sending this money to the e-commerce participant, they will deduct the tax at rate of 1% of such operator. So here one will have to realize that there is no threshold limit as far as participating person. Even if you sell goods of 10 rupees, there will be tax reduction while remitting that money. So typically what happens is e-commerce operator will really collect the amount from the person, and this particular amount, after deducting their share of commission, they will remit to the e-commerce participant. And then before remitting such amount, they have to deduct this particular 194O tax. Now, this includes various types of goods as well as services also. That is very important. And that really is a matter which needs to be understood. And especially this particular 194O is a notwithstanding provision. It's a specific provision which deals with that it will override all other provisions. Now, just imagine a situation that we will realize now currently we have been entering into this faceless appeal or faceless assessment era, and which requires a lot of specialized or specific answers to be given, or your submission has to be very detailed manner, and that submission has to be submitted, because if you make a mistake in that particular manner, probably you will realize that there will be a lot of implications on that count, and your assessee has to suffer. So one realizes that in a time to come, many e-commerce operator will come who will obtain, who will maintain such panel of experts who will be called as e-commerce participants, and there will be a buyer. That now already this particular process has started, I believe, and people are saying that if you have any query, you send us your facts and we'll give you the details of case laws and submission and everything. Now, typically what will happen, suppose take example that there is an e-commerce operator or ECO, that ECO is offering a platform to have this kind of services exchange. And there is an e-commerce participant, that is who is a tax expert, who is a tax consultant, who will really prepare a reply for you. And there will be a buyer, like say a chartered accountant also, or a direct client also, that who wants to avail this particular service. Now, typically what happens, earlier we have an understanding that if a buyer is availing services from professional services from a consultant, then there is an applicability of 194J. And this 194J is applicable. So obviously he is supposed to do the tax. Now, in this particular scenario, what happens is there is an e-commerce operator who will on that portal, that buyer will put a query or put a facts of his case, and that particular matter is given to the e-commerce participant. E-commerce participant will work on that, and he will give the inputs of that particular case, maybe in the form of submission, maybe case laws, and give it to e-commerce operator. Buyer will pay that amount, and e-commerce operator will give that particular opinion or that particular draft to him. Now, in this case, e-commerce operator will get the money, he will retain his portion of commission, and balance amount he will remit back to the e-commerce participant. Now the situation will arise that which section should operate, because when I'm availing a professional service, that is 194J directly gets triggered, and there is 194O. But now the section has made it clear that if at all 194O is made applicable, that is, if at all you are operating through e-commerce operator, the tax deduction burden is shifted to e-commerce operator, and the applicability of 194J will not be there. Because as I said, this is a notwithstanding provision, which says that notwithstanding anything to the contrary contained in any of the provisions of Part B of this chapter. So it really surpasses all the other provisions, and accordingly, this thing will function. So whenever you are availing such services, and I'm sure because many portals have really started offering these kind of services, and in a time to come, I believe there will be a lot of e-commerce operator operating on this particular service. So one will have to really be aware of this, that in that case, otherwise what happens is typically there will be two-time TDS, because 194J you will deduct on understanding that that portal is offering you service, and further e-commerce portal also will deduct. So from participant point of view, it will be two-time deduction, but then law has taken care of that. Now only situation arises that what happens if e-commerce operator, because one is not aware that when e-commerce, the issue which arises here is that there are a couple of e-commerce operator who are specialized also, who has got their own team of staff who can offer this kind of services. So in that situation, as far as the person who is availing the service may not be aware that whether this service is offered by e-commerce participant or whether it has been offered by e-commerce operator himself. So in that case, if at all it is offered by e-commerce operator himself, then obviously 194J will apply, because somebody who is specifically offering this kind of services, then obviously you will have to confirm with them that whether you are e-commerce operator or you are also e-commerce operator come advisor, because what is the exact role of yours, or your mere operator and mere facilitating the e-commerce portal to offer these services, then there's a different situation. But otherwise, 194J will apply. But if at all it is through participant, e-commerce participant, then obviously 194O will apply. And there is a distinction with that. And there is one more aspect which needs to be understood here is that there is no question of provision for suspense account. Like here, there is a distinction. Like earlier, we have seen in that 94Q that there is a payment of goods or services, and at a time of payment or credit of such sum, or even if it is created as suspense account, still it will be covered. But here, as far as this section is concerned, there is no such technically suspense account is concerned, because the transactions are pretty clear as such, because the payment from e-commerce operator to e-commerce participant will flow only if there is a very clear-cut transaction and very clear-cut identifiable party. So there is no question of creating to suspense account, but there is an exclusion of as far as that aspect is concerned. Then it talks about requirements of this section is that there has to be sale of goods or providing services. Then services to include FTS and FPS, that is fees for technical services as well as fees for professional services. And it includes taxes of digital products over through digital electric network. Then it is top e-commerce participant, of course, you have to deduct, and facilitated by e-commerce operator. So there has to be then electronic facility or platform, and it applies to payment of ECO to ECP, and direct payment by customer to ECP to be deemed payment for ECO. Now, this is also very interesting. In some of the arrangements, there is a facility that e-commerce operator at a stage itself will trigger that the after the amount of his commission, the balance amount directly goes to e-commerce participant. Is that kind of arrangements are also there. So in that case also, law has taken care that in such a case also, subsection 2 has been inserted in 194O, which says that you have to, this particular sale also will be treated as a deemed sales for the purpose of 194O. So accordingly, that particular amount we have to include, e-commerce operators to include and make the payment, deduct the tax on the entire amount, and not only on the, because so such direct payment cases also will happen, because technically speaking, this is the issue where most of this e-commerce operator, if they approach us, they ask us what should be our structure and all those things. And there we realize that while fixing the structure, they try to understand that how effectively they cannot really come out of this entire tax system clutches. But now this 194O, like for example, 2016, they have introduced equalization levy. And since then, government was always keen on considering the volume of e-commerce market in India, the way it is expanding, especially in this pandemic era. I think the e-commerce has really flourished. So in that situation now, typically, most of these cases will get covered here. As I said, that take example of Swiggy, take example of Zomato, or anybody who is giving that service or participating through that e-commerce, that particular platform. Now they will get exposed to this particular aspect, and they will have to really be aware of that. Secondly, as professional, as I have already carried out professional or technical service, I already clarified that this will be definitely one will come out of 194J, but then there will be tax deduction as far as 194O is concerned. Now, they have also given certain reliefs to individual and HUF cases. It says that there is an exemption for payment to individual and HUF cases where gross sales of services is less than 5 lakhs. Now, of course, e-commerce participant has to furnish PAN and Aadhaar card. That's a very basic understanding. If they don't do it, then probably rate will be doubled as such, because instead of 5%, it will be 10%. So this gross sales services less than 5 lakhs has to be understood in a better manner, because technically speaking, there could be a situation that a person who is, suppose we have taken example of this professional services itself, where we say that suppose a payment to e-commerce, that particular service was made at rupees 3 lakhs rupees. And now if you go by 194J, you are supposed to deduct tax on 3 lakhs rupees. But if it is through 194O medium, that is e-commerce operator through channel, then obviously once you're out, so irrespective of amount, still you're out. So maybe that will be, you have to understand that whenever such 194J has not been triggered or you have not carried out, then you have to ensure that this particular e-commerce operator has really done that particular obligation. And there is no mechanism as of now to how to ensure that, but maybe this e-commerce operator eventually will come out with such certification in the billing itself, or some procedure CBDT may clarify in the near future. Because technically speaking, it is very difficult for me to understand that at what level I will be, suppose for example, I keep on buying certain goods from a person through like, we are aware that even so many platforms are generated for selling the goods also. Now it will be easier for me to buy goods from those platforms, and I may have a huge turnover in last year. So technically speaking, there could be possibility of applying the 194O or 194Q. So that kind of confusion may also appear. and so do for services also. Now, as far as this 5 lakhs limit is concerned, one can understand that yes, this participation limit has to be qua e-commerce. So each e-commerce operator and e-commerce participant. Now, the issue arises that suppose a particular e-commerce participant, that is a tax consultant, say in case of professional services, he is attached with 4 such e-commerce operators. For example, at one e-commerce operator, he made a turnover of 1 lakh, and that way he has made a turnover of 4 lakhs with each of the e-commerce operator. Now, in that case, whether still he will be out of this particular provision, the answer is not known. Or maybe the total turnover is exceeding 5 lakhs, but it is split into the individual category. Here again, one has to really see, there is no clarification as such as of now, but one can understand that as far as the turnover limit is concerned, there will not be any TDS implication. But as far as e-commerce operator is concerned, he can always take a plea because there is no mechanism that they have to intimate to the e-commerce operator that you are I'm having such turnover with some other e-commerce operator. That is one. And secondly, this e-commerce operator work on a very efficient manner whereby their clauses are so, their agreements clauses are so peculiar that they expect that if at all you are selling on our platform, then you will be restrained from selling on other platforms. And if you are found that way, then they will have a serious implication from that agreement perspective. So if such restrictive agreements are there, so again, there will be problems. So it is better to clarify that, yes, I'm having this turnover less than 5 lakhs with your operator. Please do not deduct tax. That clarification, of course, they will take from e-commerce operator will take in future. But again, this kind of issues. Now, important aspect here now comes is a huge class of e-commerce participant, because now the concern was that there were so many e-commerce participants who were selling their goods via these different platforms were not getting caught. That was the apprehension what the department had. And considering, especially last couple of years, considering the growth in this e-commerce operator market, that is their operating platform, and the people are selling their goods to this particular platform because technically speaking, they don't require any shop. Technically speaking, they will not require anything. They can work from their home. So that kind of scenario, a large class of people, according to department, were getting scot-free. And now all of them will really come into clutches of that. And probably they will have to, again, if at all sizable operators or sizable participants are there, they'll have to maintain further records to explain this. Because as I said, it may not, again, only aimed at a collection of tax as such, but definitely there is a larger aim of collecting the data, and that data will be very useful to government to really implement as such. So, as I said, that 5 lakhs limit has to be understood in that context. Then, of course, e-commerce participant to furnish PAN and Aadhaar number. Then exemption for TDS under other provisions of Chapter 16B, that 17B that I already explained. That 194G may not apply as such as far as services are concerned. 194C also may not apply if 194O takes place, especially the urban services like urban clap. So obviously, larger services, the huge services which are cost taken, and it will be urban clap's responsibility to deduct tax and not you. As such, 194C will not apply there. Then exemption not applicable for advertisement or other services because independently they are being covered. Then there is a difficulty in cases of direct payment. We have seen that e-commerce, an e-commerce operator and e-commerce participant is defined, and it expands the scope for TDS. Then CBDT informed to issue guidelines for removal of difficulty. So that always there as such. And of course, here the person responsible for payment will be e-commerce operator to e-commerce payer participants. So that has to be remembered. Now there is a clarification. As I said, there was initially a lot of discussion that how this will operate, what kind of problem. So circular number 17 of 2020, that is 29/9/2020 dated, has given certain clarifications, and they said that further clarified that payment gateways will be exempted from this because payment gateway, typically, if you are aware that e-commerce, how it happens typically, there is a party called, say there is Amazon, or Amazon have their own payment gateway system. But you'll find there are so many other e-commerce operator who use services of other payment gateway systems, maybe Bill Desk or Bill Junction, or so many of their who are payment gateways, who are safe and secure way of transferring the money. And that particular gateway was also getting covered because technically speaking, they were also offering services. So again, there was a confusion that actually the purpose of 194E was to capture e-commerce participant and not this entire regime as such, because these payment gateways are established companies or bankers. So obviously they are somebody who are already exposed. So purpose was not to really collect tax from them. So they have clarified that is payment gateways, that is through whom the payment is facilitated, they will be exempt from this TDS, because although they will fall under this service otherwise, because service is also included here, but now they are not covered here as far as payment gateways are concerned. Then where TDS under 194 by e-commerce operator, then there is exemption for transaction securities and commodities that they have clarified, then which are traded through recognized stock exchange or cleared and settled by recognized commodity exchange as such. Then transaction electricity and general energy certificates, that also they have covered, that they are traded through power exchanges and direct transaction between buyer and insurance policy, then there is no such need. And obviously, because we know that there are respective taxes like security transaction tax and such taxes, which are directly collecting that tax. So there was no further need of any such tax as such. And of course, it has given exemption for insurance agents and aggregator from second year onwards. So any insurance agents are there, they're also been exempted by virtue of this circular number 17 of 2020. Then these are the provisions which are in the context of TDS. Now we'll move to some of the provisions which are relevant in the context of TCS. And now first provision we need to understand is again a very interesting provision, that is 206C and clause 1G, which applies in case of say remittance which are made or sale under made under liberalized remittance scheme. So liberalized remittance scheme, we know that foreign exchange earnings, foreign exchange amounts which are amounts in foreign exchange are being transferred to authorized dealer. So they sell that particular foreign currency, and that particular aspect has been included here. And also one more category has been included under 260C1G, and very interesting category, that is any remittance for education or loan from financial institution on sale of or on sale of overseas tour program packages. So even such remittances also. Now, interestingly, overseas tour program packages, that is OTPP, will include all your Kesari travels and Veena travels and Hina travels and whatnot, because the kind of movement which India has seen, like world has seen, and the tourism industry really been helped by Indian tourists is really phenomenal. Like last couple of years, we'll observe that there is a huge numbers which are going out and coming, going abroad and coming out. Now, it was not really getting checked as such, but as a matter of fact, now this 20161G has made a obligation. First, we'll see LRS. So it has been made effective from 1/10/2020, that is Finance Act 2020. So from October 20, it has been made applicable. It is applicable to any SSC, that is whoever and seller. It applicable to seller authorized dealer, applicable to seller who is authorized dealer. It talks about TCS at around 5% of AD on sale of foreign currency. So there is a TCS of as much as 5%. It's quite substantial amount. And for remitting amount out of India under LRS, liberalized remittance scheme. Now there is a threshold limit of excess of 7 lakhs in a financial year. So up to 7 lakhs in excess of 7 lakhs, if it is found, then there is a this particular limit earlier must have been kept in the mind that $10,000 was kept, that up to $10,000 there should not be anything. But as I said, now considering the dollar rate, probably slowly, steadily, this figure will come down substantially, and probably now, currently now it is something like 9,000 or even $9,500 will also get covered here as far as the remittance is concerned. And of course, it talks about 1.5% extra in case of 7 lakhs in a financial year. So whenever up to 7 lakhs threshold limit, there is a 5%, then there is a 1.5% extra amount has to be there. Then as far as the education loan from financial institution or sale of overseas. Now, whenever you're remitting any amount for education as a fees and everything, or any loan from financial institution taken, and of course on a sale of overseas tour. Now there is no limit prescribed here. So it talks about that particular agency who is remitting the money has to deduct the TDS from ₹1 or TCS from ₹1, or has to collect the tax from ₹1. And by whenever your this amount is payable, shown as a payable or on receipt, whatever is the earliest point, they have to collect that. So you will realize that now there will be additional burden of this particular 5% on this particular amount wherever one is really going for this particular scheme. So there are certain exemptions which are provided under TCS, that is aggregate amount remitted by buyer is less than 7 lakhs in financial year. and for purchase other than OTPP, then buyer liable to TDS and buyer has deducted such tax. Now, if at all buyer is liable to TDS and buyer has deducted such tax and purchased by specified notified person, then there is exception. Then authorized dealer has been defined in that case, that person authorized by RBI, obviously. Overseas tour program package defined as offers visit to country, territory outside India, includes travel or hotel stay or any other similar expenditure. So whatever amount which has been remitted to outside India for any such booking and everything will get covered here. Now, what interesting fact I understand this particular section, again, maybe one aspect is that this particular section, how much tax government will collect is not really issue, but here the government will be in an absolute position of entire information of those who are traveling outside for education, for any purpose, for business purpose, and what is the amount of foreign currency which has been traded. Like LRS, they will first, this authorized dealer has to really give a details of PAN number and everything, because if at all PAN and everything is not there, there are some other consequences. So obviously, one will have to be very careful on this aspect now, that whenever such amounts are getting, you are doing any transaction with these people, these amounts are going to get exposed in your return of income, because that is very important. Because definitely now we are heading towards these technological innovations, and we are talking about this a site which will be made on the basis of artificial intelligence and machine learning kind of thing. So where all these elements will really capture, this data will be gathered from different resources, and one such resource will be a TDS and TCS. And there, those respective PAN numbers and Aadhaar numbers will be really captured. And therefore, one will have to be very careful. Now, whenever such transactions are there, earlier, many people, we used to help our relatives or friends to use our bank account, to use our account to facilitate them for transferring this money and all these things. But one has to be careful now, because now the PAN number which goes for this particular transaction, this PAN number, the entire transaction will get reported. And obviously, one will have to take care of that. Because from an implication point of view, maybe authorized dealers and all those things, they will be equipped. So we will not really be really have to bother really that how this will happen or whether there will be default from our side, because we are a buyer. But as a matter of fact, this particular information is going to get captured and get reported in your tax returns. So obviously, one shall be ready with that entire answer, that how and when and why and from where, what was the purpose. Maybe especially now, so many cases like our clients, doctor clients get money, this particular trip transfer sponsored by the companies, medical companies, conferences sponsored by the medical companies. Now everything will get exposed, because technically speaking, you are not making payment, but your PAN may be used, because payment is made on your behalf. So obviously, your PAN will get used, reported. Now in that case, although since and many people never used to show this kind of conference, because technically speaking, Section 28 does capture this kind of any value of benefits received by you. So if at all they give you your PAN number, probably you will have get this information on your portal. And typically speaking, even if they don't give your PAN number, but if you have bought any foreign currency and if you have made any payment for that purpose, then obviously that will also get reported. And obviously they will come to know that you have done this travel, and obviously consequential amount, and they will ask you that from where did you really invest the money. And if you say that it has been sponsored by somebody else, then obviously Section 28 provisions also get triggered. So technically speaking, it will have lots and lots of implication as such. So one will have to be very much aware as far as guiding the client, that whenever any one of your client is dealing in this kind of situation, they should be told that please now be aware that this will get reported in your return, because the PAN numbers and everything will be captured at the initial stage and will be shared by that particular authorized dealer to the department, and department will definitely come to know that there is such arrangement or such action has taken place by this particular person. So obviously some of the provisions will be very interesting in a time to come to know, because it will not be really it will not really matter how much tax they are collecting, because ultimately we are going to get a credit of it. But the kind of information they will get will be very specific, and it will be linked to your particular PAN number. And obviously, as we understand the machine learning concept, whereby this concept machine will really capture various details and understand the functionality of that particular person independently in a time to come. Then again, one more controversial aspect, that is like 194Q has come in effect from 1st July 2021. But prior to that, we had 206C1H section, that is TCS on sale of goods, and which was introduced from 1st October 2020. And lots has been discussed on this. Again, as I said, as a basic section, we have this 0.1% on aggregate value of goods. And then it talks about additional 1% if non-PAN or Aadhaar card cases. There is a specific section called 206CC. Then there was a threshold limit. We understand that 50 lakhs in financial year, and there's a TCS on value of goods in excess of 50 lakhs for financial year. So services not included. Here, important part is that it is only for goods, unlike in 194Q also. Here it is only for goods, and services are not specifically, services are excluded here. So if there is a service in excess of 50 lakhs rupees payment, then now only difference what we have to understand, this TCS is on a seller and it is on receipt of payment. It is not on technically sale transaction per se, but it is on receipt of payment. So whenever a person has sold particular item and then he receives some amount, and that amount exceeds 50 lakhs rupees, then there is a requirement of TDS. So it says that you have to deduct the sale of any goods other than goods exported outside India. Then alcoholic liquor for human consumption is excluded. That is excluded because there is a specific TCS provision. And motor vehicle value exceeds rupees 10 lakhs, that is excluded, and overseas tour program package. Now, why these exclusions are there? That is because there are specific TCS provisions are there. So obviously they are not covered here. Now, it talks about value of sales exceeding rupees 50 lakhs in a previous year, and seller sales for a business should be more than 10 crore in previous financial year. Now, this is again obligation on the seller himself, that if it all is financial years, previous financial year's turnover is 10 crore or more, then he has to monitor that every sale, on account of every sale, whatever receipts he gets, that the moment it crosses 50 lakhs in aggregate, the provisions will get triggered and he'll have to collect the TCS on that purpose. Now, exemptions are provided under TCS, that is buyer liable to TDS and buyer has deducted such tax, it has covered specifically. So 194Q, there is a specific, if at all any TDS is deducted on that particular sales, so they say that you have to ignore that. Then they have defined the buyer, which includes person who purchase any goods, and excludes specified person, local authorities, and person imported goods into India, and notified person. Now we are aware that 206, a lot of literature has taken place, and initially they have there was a lot of confusion, a lot of clarifications were issued in that context. And then that was not sufficient. They introduced 194Q. So many issues have cropped up in this particular two directions, but how exactly the both will function and how exactly efficiently this will really happen. But as a matter of fact, now they have tried to clarify this. So we'll see that aspect also. Then TCS on sale of goods, seller have been defined as seller gross receipt turnover is more than 10 crores. So he's not a notified person. Then circular number 17 again has clarified certain aspects in this context, whereby they say transaction securities, commodities. That is again, has been exempted as far as 1H is concerned. So they have categorically excluded this particular aspect from this applicability of TCS provision. So that is in the context of 266(1)H. Then there are a couple of small changes which has taken place in 196D, that is TDS on income on FII from securities. May not be that much relevant, but that's it. Amended to rationalize withholding or payment made to foreign institutions that TRC is submitted. So by a person specified 91 or 90A1 as required under 190A4, then benefit of tax to be deducted lower of DTA or applicable rate of tax. So one has to be aware that yes, now if at all you have to submit it, FI has to submit a TRC, that tax residency certificate, to the deductor, and then in that case 196D they will be definitely given the lower of benefit of DTA or applicable rate of tax. Then there is a 196(4)IB, that is TDS on rent by certain individual HUF. We are aware that not 196 or 194IB, there is a typographical error. 194IB it should be, not 6. So there they have included 206AB also, and we'll see what is this 206AB, why this is included, because they say that we are aware that even if now a person who has taken a property on rent and he is paying monthly rent of 50,000 rupees or more, that in that particular case he is supposed to deduct a tax at source under section 196 AB IB, whereby this particular amount will be paid on that particular 50,000 rupees and more. So the mechanism here provided is something akin to what we have in 194 IA in the context of property transaction, whereby there is a specific return provided under this, under that is 26 QC is the return specific provided, is a return come challan, and person will have to really deduct the tax and pay that amount. Here they have categorically said that 206 AA and 206 AB, that is 206 AA is the person who is not having PAN number, or 206 AB now we are talking about, we are going to talk about non-furnishing of the PAN and Aadhaar. So in that case, if at all that number is not there, then this amount has to be deducted at a double the rate. That is what they have said. But again, they have given a certain benefits that if it is paid in the last month, then you don't have to deduct full TDS. That the entire amount cannot exceed the rent amount as such. So that is what the clarification has been given in this particular section as per amendment is concerned. Now, again, we are aware that new sections are introduced, that is from 1st July 2021, that is 206 AB first. This special provision of TDS for non-filers and return tax returns. So it says that if at all a person who is availing the services or anything of that sort or purchasing of goods and is a non-filer, then they have specified that higher rates will be specified for non-filers. Then it is not applicable to provisions of 192, 192A, 192B, 194BB, specific provision, and 194N. 194N, of course, is the cash withdrawal. 192 is a salary, and 192A is a salary. So specific provisions have been excluded, and it is not applicable to non-resident who does not have PAN in India because they have been covered by separate provision of 206CC. Now, as far as the rates are concerned, it talks about that you have to pay as per 206A, that is applicable where PAN not furnished, and rates under 206, which is higher of twice the rate specified in the relevant provision or twice the rate in force or 5%. So wherever there are rates like 0.1% or anything, so in that case it will be 5%, but otherwise in all of the cases it will be double the rate of that particular amount. Then they have specified a person that who has not filed return of income in immediately preceding 2 previous years of such previous years, and time limit under 131 has expired for such previous years. An aggregate of TDS and TCS in this case is more than 50,000 each of these previous years. Now, this is with reference to 206 AB, and then we have also this 206 CCA, that is special provision for TCS. So 206 is for TDS and 206 AB is for TCS, that is again for non-filers of income tax, and similar kind of mechanism is provided. Now here also it is made applicable on 1st July 2021. So it is now advised strongly as far as now, first I will think from a chartered accountant, practicing chartered accounts perspective, that what care we should take first as far as while complying with this both the provisions 206 AB and AAB and CCA. We have already made a declaration on our letterhead specifying that we are the provisions or relevant provisions of these sections are not applicable to us, and we have filed our return of income for last 2 years. And what we have done is that we have captured the first portion of ITR 5, which shows the acknowledgement number and date of filing, and we are excluding that portion of our income portion because there is no need that we should get exposed to our income portion to everybody around us. So we are just trying to capture that ITR 5 image and copy paste and give a letter and a declaration that yes, we are filed our return for 2 years, and by default we are sending it to every client, right? Because as far as first is our concern first, that we must send it to every client who are actually deducting our tax, and wherever we are supposed to getting exposed to this kind of transaction, we must give this certification or letter along with the bill itself. Means whenever you are sending bill, if at all it's a one-time client, then you can send along with the bill itself that we are not exposed. And ideally, if at all we can have this particular declaration or certification printed on the back side of the bill, probably that will also help, so that a bill will contain that entire information, that provisions of section 206 CA or 206 BBA, AAB will not be applicable. That is one. Then as far as clients are concerned, as I said, similar direction has to be issued directly, immediately to the client, that please, because this is already made applicable for July 2021. Many companies are already suo moto asking this kind of declaration from their client, But as a good practice or as a better practice, I strongly feel that you must advise your clients or send immediately them these drafts specifying that they should immediately inform all their clients by mail or by physical delivery or by post that these provisions are not applicable and you have filed your return of income for last 2 years and your TDS, although your TDS has exceeded 50,000. However, if such information is not made available or such declaration is not available, then obviously you will be exposed to this kind of deduction as such. So obviously one will have to be very careful on this part that whenever such, of course, one can argue that this is ultimately going to get refunded, but definitely on the initial stage, the amount goes in substantial amount will go because tax is almost double the rate. So we must, like in our case is 10%, so it will get shifted to 20%, so which can be avoided. So one must be aware that this provision has to be brought to the notice of every assessee of yours. First of all, implement yourself first, and then it should be brought to the notice of every assessee of yours. Similarly, it applies to both the ways. That is, every person who is supposed to liable to deduct a tax, you have to intimate them. Either they have to bring get the declaration from their customers or a person who are responsible or pay and keep it on record, because this maintaining the record also will become a part of our job, because tomorrow you cannot presume that without any declaration, technically speaking, there will be an allegation that no, this kind of declaration, whether if it is not signed, and I insist that it should be a signed declaration, because many times what will happen that there could be some mails which are being exchanged, and that may not be considered as sufficient compliance. So you must have a signed declaration and supported by the proper ITR 5 copy, because that will be very clear proof that yes, there is a very clear following up of that particular aspect. So one will have to take care of these two sections independently. Now coming to this interplay between these two sections, that is 184Q and 12061H, just because we'll be spending some time on this as two sections now, because they are going to create a lot of issues and problems as far as understanding is concerned. So plain simple understanding, we understand the nature as far as 194Q is concerned. It is tax deduction the source, whereas 206 is concerned is TCS. Then TDS obligation is obviously on buyer and it is on seller. Then obligation vis-a-vis turnover. So turnover of buyer exceeds 10 crore in preceding financial year, whereas TCS says turnover exceeds 10 crore in preceding financial year of seller. Then transaction limit in the previous year is 50 lakhs, more than 50 lakhs, here also 50 lakhs. And nature of payment received. So as far as 194Q concerned, any sum or purchase of goods. So it goes qua bill as such. Whereas 206 talks about consideration for sale of goods. So it is on a amount which is received. So there may be a bill of whatever amount, but what matters as far as TCS is concerned, that will be the amount of bill. And here also we need to understand that typically from a seller perspective, it becomes difficult because seller otherwise is supposed to get 100% money what amount he has sold. So obviously he has to charge that additional 1% to the buyer, and then he has to recover, or he has to raise a debit note specifically for that 1% as such to collect that particular 0.1% as such to collect that amount. Then timing will be, we say that yes, as far as 194K is concerned, trade of payment or whichever is earlier, or even suspense account. Section 206 talks about only on receipt. Then rate is again 0.1% or 5%. Here rate is 0.1% or 1%. Now, as far as not applicable is concerned, TDS provisions, if tax is deductible under any other provisions, then there is not applicable, or tax is collectible under 2061H, then also not applicable. Now, as far as 206 is concerned, if tax is deducted buyer under any other provisions, then it is not applicable. And deducted collectively any person who is resident, that is seller, and in 206 it is a person who purchases goods but does not include government, etc., local authority or import. Now, the main aspect which we need to understand in this two sections is that which section to select, because how to have this interplay between these two sections, because it is very difficult to identifying applicable provisions, because they operate on an independent basis, both the provisions, because buyer will have to see from his perspective, seller will have to see from his perspective, and both of them cannot take charge, cannot take a different position. They have to go by abide by the law. Now, as far as 194Q is concerned, there is a serious implication also from the point of view of 40A1A disallowance. Whereas 206, there is no such disallowance as far as 40A1 is concerned, because if at all, from buyer's perspective, is more beside the normal penalties and interest. As far as 40A1 disallowance, which considered as a harsh disallowance, 194Q is directly covered there, but as far as 206, that is not covered. And how to choose this option, because which right provision, who will collect, how will collect, and what happens if it is collected but not paid. So many issues are going to come. So it not, and by even if one complies with one other provision, it is not eliminating the other person to not comply. So they are mutually exclusive in nature generally, and there is a possibility of dual application as such. So definitely one can say that is both provisions are overlapping each other. Now, having said this, now CBDT has realized this particular difficulty faced by people, and they have come up with the circular, recent circular of 30th June, that is circular number 13 of 2021. And they have made an attempt to really clarify various issues in this context, which could be helpful for all of us. Like first issue was in the context of 194Q. Now they say that this will not be applicable. Like from earlier 17 of 2020, they have given clarification that it will not be applicable to transaction of securities and commodities, to 194O and 2061H also. But now 194Q also they clarified that this will not apply to securities and commodities and electricity, renewable energy, and all those contexts. So as far as 194Q, now there is a relief to that extent, or there is a clarification to that extent. Then it will not apply to any sum credited or paid before 1st July 2021. Now, typically what happens, since 194Q should have been made applicable from 1st April, but because the guidelines were not there, now they have made it applicable from 1st June 2021. Now the issue arises that it talks about what happens if I already debited, credited 50 lakhs rupees prior to that amount. So they say that this particular, any transaction which is recorded prior to 1st July 2021, this provision would apply. So any amount which will be further sold after 1st July 21, it will apply. However, they have also further clarified that if prior to 1st July 2021, you already booked more than 50 lakhs rupees turnover, then from 1st June, it will be applicable as such. So they say that if already you have credited 50 lakhs rupees, then you have to consider that it is applicable from 1st April. So that clarification has been made as far as the turnover is concerned. Then adjustment for GST or purchase return. So as far as first part, we are aware that yes, GST, they have clarified that you have to exclude GST while computing 194Q provisions. So you have to take a net off position as such. So that they have made it clarified. But if at all any advance payment has been made, then there is no such bifurcation. So any amount of first payment is made and TDS is deducted, and they said you are not supposed to deduct, take out GST element from that. So if any advance payment is there, then 194Q will apply on entire amount, and GST should not be excluded specifically. That's a clarification. So if at all you are charging on a bill, then obviously you will charge on only net amount without GST. But if an advance payment is received, and if you are charging a tax, deducting TDS on that particular advance payment, then you have to deduct on the entire amount and not on the net amount. Then what happens to purchase return? They have clarified that purchase return is something on which already 194Q tax has been deducted. So against this particular purchase return, when you reverse it, and if that money is refunded by the seller, that money physically has been refunded by seller, then this excess tax which has been paid under 194Q, you can adjust against next purchase against the same seller, because CBD doesn't give anything open-ended. They have very made category that if it is a purchase return, we have to have a clear accounting whereby you will show that purchase return, then that particular amount has to be actually repaid by that seller to you. In such case, you can carry forward that particular deduction to his next purchase from the same seller. Means it is not that that amount can be adjusted with any other seller for that matter. You have to adjust with the same seller. So that kind of restriction has been clarified. But if at all this purchase return is replaced by any other goods by seller, then there will not be any adjustment, because obviously logically it will not have any implication as such, because there is no separate payment as such. But since already tax has been deducted under 194Q, there is no need, when you're replacing the goods, there is no need of deducting one more time. So such cases has been clarified under purchase return. Then provisions of section 194Q shall not apply to a non-resident whose purchase of goods from seller resident in India is not effectively connected to the P of such non-resident in India. So this clarification is also very important from the point of view of that if at all there is isolated purchases which are made In that case, obviously, if that particular entity do not have P in India, and if it is not for that non-resident is not having any P in India, then the 194Q is not applicable. That is the clarification which has been given. Then 184Q of the Act shall not apply for purchase of goods from a person being a seller who as a person is exempt from income tax under the Act. So if a particular person is exempt from income tax act, like provisions of section 10 are applicable or provisions of section 11 are applicable, and if they have such certificate holding with them, then 184Q provisions may not be applicable to them. Very categorically mentioned that if such persons are purchasing, because technically speaking, their incomes are exempt as such, and since the income is exempt, there is no occasion of, like, only for the purpose of claiming the refund, they will have to really file the return of income. So it has been graciously pointed out that yes, such cases, there is no need of deduction of tax. Then provision section 206(1)(h) also, they have categorically said that if the seller, again, they falls into the same category, then also it is exempt from income tax. Especially this applies to many specific companies which are pronounced by the government that their income is exempt. So in that case, to avoid that duplicacy of procedure part, they have clarified this, and this will really help those categories who are not eligible to file the return of income, or who are exempt, that whose income is per se exempt from the Income Tax Act. Then provisions 194Q will apply to advance payment made by a buyer to the seller. So obviously, this particular aspect will be there, that if there is an advance payment, then provisions of 194Q will definitely apply, because it talks about payment or a credit, whichever is earlier. So it will apply. Now, one more clarification has been made, that provision of section 94Q of the Act shall not apply in the year of incorporation. That is, the issue has been raised that what happens if suppose it's my first year of business, and then I don't have previous year data. Legally also, there was no such binding, because technically speaking, section was also clarifying that your previous year's finance year's turnover should be more than 10 crore. Now, if you do not have a business at all in a previous year, there should not be an applicability of 194Q. But they have further clarified that in the year of incorporation, it will not be applicable. It will be applicable in this latter year. And again, logical. And turnover received from non-business activity is not to be counted for threshold of 10 lakhs. And this is very important, because here it says that you have to compute the turnover receipt from non-business activity. For example, suppose a person is having a total income which consists of business activity and non-business activity. For example, rent income is received, capital gain is received, and so income from other sources is received. And if you aggregate the total turnover of that particular entity, it may cross more than 10 lakhs. 10 crore, it should be not 10 lakhs, it should be 10 crore, I believe. But then there is a typographical error. But then they have categorically said that it only talks about, suppose, for example, I have a turnover from business of 9 crore in previous year, and my other income is 5 crore. So they said that it will not be, provisions will not be applicable, because you have to consider only turnover or receipt from business activity, and non-business activity has to be excluded. So accordingly, if it is 9 crore, then you will not be applicable. This provision will not be applicable to such person. Then very important that we were discussing about overlapping. Like there were 3 sections which were really having a clash among themselves. That was 194O, which is e-commerce, 194Q, and section 206(1)(h). So it has said that if tax has been deducted by the e-commerce operator under 194O, then provision of section 194Q as well as 206(1)(h) will not be applicable. So they have made it very clearly that if 194O happens, then none of these sections will apply. For the first reason is obviously they have given 194O is a notwithstanding provision, and it categorically says that it will not really apply the other provisions of this section. It will override all other provisions. So obviously 194Q gets overridden. And they have also clarified that 206(1)(h) also will get overridden by that. That is one part. Now it becomes very essential for us to know that whether this e-commerce operator has deducted the tax or not. Because how do we apply the 194O, whether it has been done? Because technically speaking, we understand that this particular, as a buyer, what happens is typically I am just buying the goods from the e-commerce portal, and I am presuming that e-commerce operator has deducted the tax from e-commerce participant. Then only I'll be out of it. Now, if that presumption goes wrong, then I get caught into this. So obviously, they have to give a mechanism to know that whether such declaration, whether such amount has been deducted or not. So probably they may come up with declaration in the bill itself provided by e-commerce operator, specifying that we will be deducting tax. So that may be sufficient compliance. So in such a case, of course, provision of section 194Q as well as 206(1)(h) not application. Then as far as 194O and 194Q, if there is a split, like they have also categorically said that if it is quite possible that in some cases there could be possibility of 194O application, 194Q application, or 206(1)(h) application. So they said in that case, 194O will operate first. That is very important because again, they said that because they are capturing that event at e-commerce operation level itself. So obviously, once they capture that event at that level, then there is no further obligation on the buyer to really apply or seller to really apply this respective provision. So they said if at all on 194O, if some transaction comes under 194O, it will be always first 194O, and then in that case 194Q and 206(1)(h) may not be complied. And last but not least, that is if tax is deducted under 194Q as well as 206(1)(h), then it shall be first deducted under 194Q. So at a time of raising the bill, and it is a really logical because 206(1)(h) was really extending it further and was creating an issue by itself, whereby it was really a problematic situation which was coming up. So technically speaking, they said that if at all there is a such overlapping which arises, then 194Q will have a first implication, and it should be deducted under 194Q. That is, the buyer has to deduct the tax, and once he does, obviously 206(1)(h) excludes that independently, and he has to accordingly intimate. So what is required is that there is a seamless communication is required now between these three agencies, because buyer and seller, and of course in e-commerce operation scenario, e-commerce operator also. So obviously there should be a seamless information flow of your PAN number, of your Aadhaar number, of your updation of exactly who is deducting tax, and such information has to flow in a manner, or maybe electronic manner one presumes, but then we'll have to really wait for that particular kind of scenario to come as such. So you'll realize that circular number 13 has clarified most of the issues which were there or bothering all of us. But again, as I said, we need to really have a robust mechanism of exchanges information, and many information now we have to share with our client or with our all these people, whereby we make it clear that yes, what is our PAN number, what is our Aadhaar card number, whether we have filed a return of income, then supporting of that, then whether TDS deducted on our part is exceeding 50,000 in a year in last 2 years. Then so much information now we have to give and share with the respective parties, and it is in our interest, because if at all such fault is observed, the respective agencies either will double the tax rate or will apply the special rate, and there will be unnecessary excessive amount will be deducted from your payments. Similarly, this particular information, as I said in the beginning, in between, that this particular information is going to create a lot of database for us, for department, because as I said, they are talking about completely automation of this particular process, whereby a lot of database in terms of your PAN number, your transaction, everything will be captured and it will be linked to your PAN. So tomorrow the department may also have that from what are the details what kind of orders you have made from Swiggy and Zomato, and what kind of subscription you are making through your on OTT platforms, and an n number of situations probably, and they will be aware of all these transactions happening through your portal or through your through these agencies who are doing this tax deduction and source and TCS and all those things. They will also have this lot of information collected and tagged to your PAN number. And then obviously one gets exposed to explaining all this transaction, because we are talking about pre-filling of return, pre-filed return, they're coming. So obviously this information is going to be really, really, what one can say, a boom for government, but then may not be, maybe if at all you are complying with everything correctly, then there should not be any problem. But typically speaking, one single movement, like I always say that we used to believe that number one and number two market exist parallelly. But now, technically speaking, we have to understand that there cannot be any intersection now. Earlier, so-called number two transactions were getting merged in number one entries, and then there is to be, it was getting regularized. But now there will be two separate streams, and they cannot really mix up now, because whatever transactions are happening on a regular portal, considering GST and all other aspects, you will realize that it will be a completely under control or clutches of government. So every movement will be captured in a time to come, of course, because they are really gearing up for that. And it becomes so, like, I don't know, are we talking about that real Ram Rajya to come, that yes, everything will be so transparent and so clear that person will not be able to do anything with that particular aspect. But of course, this is not something new, because all the developed countries really see this kind of developments everywhere. In developed countries, these controls are very much in place and they are functioning. But the only difficulty in India is probably our population. It's a huge population they have to cater. So obviously controlling them in such a manner, and basically to bring them out of this particular uh, mindset as such, will be a tough cost call as such. So we'll have to wait and see. Maybe they will focus currently on those taxpayers who are registered with the DEM and those who are having PAN and other number. But there's a huge class of society, or huge numbers in percentage, also huge numbers, who are not having PAN number and not having Aadhaar card. So probably currently the scenario only talks about doubling their rate of TDS, but there is no such mechanism of catching them as such, because there is no control over them. But now eventually they say that yes, they will make it so strict that whenever you are registering your bank account, whenever you are registering your car, whenever you are doing any property transactions, these numbers will be made mandatory. And if you do not supply these numbers, probably you will not be able to do the transaction. And the moment you take that number and supply that number, you will be into the system as such. So it will be very interesting to see that particular movement. And from our perspective, that is a practicing chartered accountants perspective, I believe this is going to really, for us also, to understand this pulse of this particular movement which is happening, and to change our business or working professional modules. That is the need of the hour, because currently now it's not that how many number of return I will file, that I have file 500 returns or 1,000 returns. That hardly matters now. Now what will matter is what efficiently you are giving service to your client. Because what is going to happen that now the filing simple return also will not be so simple, because now virtually you have to wait for that onward 26 AS and that so-called pre-filled return. And you have to sit with the client and go through each and every entry of his account, because you don't know from where it has come and how it has got reported in government account. So you'll have to really correlate that entry and accordingly prepare that return in a most efficient manner, and then only submit that. Because a single mistake really causes a matter of worry. Like for example, we realized that last year in one of the cases, now that particular CA is now representing that matter in e-assessment. But what has happened is, in the firm case, wrongly he has put the salary into, say there are 3 partners, and he has put that salary into a partner to whom it was not paid. It was paid to somebody else, other partner. Now in that other partner, that salary was shown. So in the firm's case, that particular partner's name has captured. Now the scrutiny has come only for that, because you are not shown that salary of that firm, because that firm has shown salary to you, but you are not shown. So, such a small aspects also, we feel that it's an inadvertent mistake, but an inadvertent mistake will result into a sort of scrutiny kind of situation, because the reason itself is given is that remuneration not shown in the income. So that kind of precision is expected, that you have to be very alert, because many times our students or our CS or article students or staff files a return, and they also file it electronically. We find it easy. But now this mismatch or this capturing of wrong information will really result in, suppose now they're asking about tenant's number, PAN number and everything. And if you put that PAN number or tenant name, then obviously that information goes in that his PAN. Now, typically, if it is put wrongly, then obviously, so this kind of mapping is going to be a need of the hour. And obviously, one will have to understand that whatever answers you are giving in the return of income, it will be a very, you have to monitor it strictly. You have to understand that particular question and accordingly give it, so that one will be able to justify at a later stage. So that was in the context of this various amendment which has taken place and the issues. Now, of course, when I was referred these issues, and I was of opinion that probably I have to answer the issues for this new amendment. But somehow I have been shared with some of the issues. Like there were quite a few. First lot was 5 issues and then 15 issues. But I've just taken the first 5 issues, because 15 issues were really talking about some other issues, and that not related to amendment of this particular section. So amendment section, probably I've tried to clarify most of the issues. I'll just take a couple of issues which was referred to me, which I can explain in a shortest possible manner. because they are not related to the amendment. Basically, that's the reason. And maybe we can have a separate session for the TDS issues, because it has interesting issues have really come up, but then it requires a deliberations further. Now, as far as the first issue is concerned, they are talking about that leasehold property in MIDC, and they have entered into a notarized MOU, that is Visar Pauti, with another buyer for a leasehold property. So the concern is that whether 194 IA applicable to leasehold land. Now, again, as I said, typically 194 IA wording, if at all you see, it refers specifically land and building or both. And that particular wording, if at all we are aware that we have a couple of judgments in that context, in the context of 50C, whereby they say that whenever this land and building word is used specifically, then probably we have to restrict it to that, because earlier, like, we have a section called 269UA, whereby for term immovable property was explained, and immovable property was explained to include land and building and rights therein. So such immovable property word is not used here, and whereas the section categorically uses the word which talks about transfer of any immovable property other than agricultural land, and then further immovable property, they define that it means any land other than agricultural land or any building or part of building. So they have had an occasion of defining immovable property. So one argument one can make is that technically it should not apply to leasehold land at all, because of the reason it talks about immovable property means land or other than agriculture, building or part of building. Now again, land ownership is understood as ownership, own land or leasehold land, freehold land or leasehold land. Now, technically speaking, in leasehold land, what we are enjoying is only the possession of that particular land, and that possession gives you only use of right of that, right to use that land, and nothing more than that. Maybe if that right is coupled with the selling right also, but for the selling right, you have to necessarily pass through this MIDC or the agency through whom which this particular land is given, and you have to pay the premium to them also. So in that situation, one can always argue that this is a leasehold land and therefore provisions are not applicable as such. But again, as I said, under TDS regime, whenever you are advising on such positions, you have to take care, because there are two aspects of it. One, your client getting stuck with this particular provision. Is the argument available? I strongly believe that argument is definitely available, but it's a matter of litigation that you have to argue in the latter before appellate forum, and not at the AO level. Nobody listens to you. So obviously, if AO takes that view and charges you interest and penalty and all those other consequences, then obviously you have to defend. And at the time of defense, probably these arguments can help us. But if at all you are advising at the beginning stages, obviously in TDS regime, one always understands and believes that one has to advise them that you have to take an abundant precaution or caution, that because there's an implication subsequently. So if at all it is possible, you deduct tax and pay the amount. Now, under it shall be deducted as seller and consenting party, or TDS under will be applicable for consenting party. Now here again, as I said, it typically government wants to capture the consenting parties mainly, because the seller and consenting parties are there. So obviously, technically, consenting party is the person who is holding that right and who is selling, and substantial sum is going to him, because independently premium will go to the government agencies like MIDC or anything. But as far as you are concerned, you are making payment to the main to consenting party. So obviously, you have to deduct that part TDS on that particular amount of the consenting party as such. Now, as far as 194H is concerned, commission provision, I strongly feel that it may not be really looked at from commission provision, because it cannot be termed as a commission as such. So one will have to really think on that aspect. But technically, yes, 194I, one can advise that one should deduct the tax. Then there is a typical arrangement which has been thought of, but again, independently, it says that fact says that A cannot borrow from bank because his account is NPA. Therefore, tripartite agreement is entered between A bank and X. X will borrow from bank and will transfer the loan amount to A, and interest amount will be paid by A to X, who in turn will pass on the same to bank, and whether A is liable to return. Now, typically speaking, I'm not really sure whether this kind of arrangements are permitted, because now the fact suggests that bank also is a party to this tripartite agreement, and bank, having aware that A is NPA, has given it to X. So probably this amounts to window dressing, according to me. And this kind of arrangements are really not permitted per se, because if this thing happens, then probably monitoring NPA purpose will be in the trouble. So first of all, I have my reservation on whether this kind of arrangement will really happen. Now, independently assuming that if this happens without a tripartite agreement, but suppose X takes the loan and give it to A, and A then repays the EMI, then obviously independent TDS provisions will be applicable for the transaction between X and A, because if such tripartite agreement, I personally feel may not be the reality as such, but if at all such things are there, I will have to really see that what kind of wordings are there in tripartite agreement. But assuming such tripartite agreement is not there, then X will be liable for TDS to when he is making payment to A, because it's a clear-cut interest payment made by him, irrespective of the fact that same EMI is paid to other person, because it amounts to application of that fund. So it hardly matters as far as A is concerned independently. Then again, it talks about if a person is governed by presumptive taxation 44AD, he fails to deduct TDS, whether his presumptive income can be increased by disallowing expenditure, and whether he will be liable for personal penal consequences or non-deduction of TDS. As I said, yes, when he is not maintaining books of accounts, then typically speaking, he cannot be said to be have exposed to tax. Now, as a matter of fact, we have also seen when we are discussing about those provisions, relevant provisions where non-deduction of TDS, whether it will really that 194C and 194I, they have changed the definition. That is, they have said that it is more than 1 crore or 50 lakhs rupees for business. And now that is no more with reference to 44AB. So now here the situation arises that in 44AD, you are not maintaining books of accounts. And if you are not deducted tax, then whether it will be that presumptive income, can you say that? Now, technically speaking, if you go, as I said, strictly by the wording of law, you are supposed to deduct the tax because there is no such exemption given. But as far as judicial proceedings are concerned, we have a couple of judgments in that context wherein we typically use for that purpose, when we understand that such a situation like Punjab Haryana High Court, we use many times 242 CTR 61, that is CIT versus Surinder Pal Anand, whereby it was in the context of 68, 69 addition, and income was taxed under presumptive taxation. So Honorable Punjab Haryana High Court has said that if at all it is under presumptive taxation, then there is no further implication as far as the 68, 69 is concerned, because you have taken business as a whole. So you cannot take in isolation one entry each, because there are no books of accounts. So you cannot take such isolated entry in connection with that particular business, and you cannot tax that. So by using that particular analogy, there are a couple of tribunal judgments. One is such a ITU versus Mark Construction 602, ITA number 602, Kolkata 2011, or 124 taxman.com 236, that is Bipin Chandra Surat High Court, which is tribunal, which is recent judgment, which has said that yes, in that case, 40A 1A disallowance should not be there when income is under 44AD. But as a matter of fact, now in the new definition specifically, where this distinction, they have said that 1 crore and 50 lakhs. So I personally feel that now 44AB reference is no more there. So one will have to really be very careful while advising such things, that there can be a possibility that, because what happens is department may argue that 40A1A disallowance is qua expenditure. Now 44AD presumes that expenditure is deemed to be unallowed. So even a particular expenditure which is allowable otherwise will not be allowed if TDS is not done. And if that is the interpretation the department takes, then it becomes a very serious game plan, that whether to rely on this tribunal judgment in isolation, or whether to advise client not to deduct tax at all, first of all, and then argue in a litigation. Probably, definitely, it is a matter to see how it will get developed. But it's a real catch. A real catch is there, and one have to be very cautious while advising these issues. Then issue is about royalty payment, that is 195, and foreign entity does not have business establishment pan India. How can we issue Form 16, whether it is possible? I must first of all point out, wherever there are no PAN cases is there, technically speaking, there is a difficulty otherwise also, because why not foreign company, you are not entitled for even deduction in India also if there is no PAN, because the mechanism doesn't get completed, and then the figure, although it is deducted and paid to government, but there is no mechanism of claiming it back. So that is real problem. Now, maybe CBDT will have to come into play, because this 16 number really matters to them for a simple reason, because they may have to claim it there in their country, that such tax is deducted, resulting taxes there, and kindly allow me the credit of that. But in that case, obviously this Form 16, currently, I don't find any such mechanism that how it will be generated. Maybe we'll have to really see how effectively this will take place as such. And then mistake, of course, no answer available as of now because there is no mechanism of revising the returns. Obviously, there is no answer. Maybe we'll have to wait and see how this new portal will react to this kind of situation and whether such answers will be made available to them. Then issue 5, I will not really deal with that. It's an elaborate issue, and probably it will take some other time, or maybe some other time when we discuss about TDS issues. It has got a very different shade. It's a very interesting query, but it has got a different shades. And when I have to understand the matter of discretionary trust and all other aspects and non-specific beneficiaries or specific beneficiaries and all this purpose, everything has to be understood in detail. So I'll just skip this query. So considering this aspect, I really thank organizers of this particular event that they give me a chance to really go through this provision in detail. And really, first of all, whenever I get an opportunity to share the views, it really gives me first chance for me to go through the provisions independently to understand them and enrich oneself, and then probably try to share that knowledge with others. So I thank organizers for this opportunity given to me, and thank all of you for this purpose. And if there are any queries, we can take in a short time, or we can close this session. Thank you very much. Over to you, Chaitanya.
Yes, sir, there are few queries. So for the first query is, under section 194Q, the threshold limit of 50 lakhs should be considered from July 21 or should also consider from April to June?
In that circular, what I referred of 30th June, they have referred that if at all any turnover, if at all any bills are booked prior to 1st June, so you don't have to apply to them. It will be from 1st June onwards. However, if prior to 1st June already 50 lakhs rupees turnover is booked, then in that case, it will apply from 1st of April.
Okay, sir. So the next question is whether sale of scrap to a manufacturer is liable to TCS under 2061H.
Technically, they, as I referred, they have excluded those sections which are there as such in terms of wherever other TCS provisions are made applicable. 1H has been excluded. They have excluded that. So I don't think there will be any double taxation. It will be specific section will override.
Okay. So now the next question is on purchase of petrol from IOCL, whether petrol pump dealer is required to deduct TDS on basic amount or on basic plus VAT.
That in about this circular referred about GST, they said you have to exclude GST amount. That is what they have clarified. Because the bill is there, but they have also clarified if payment is received advance, because basically what happens is in this IOCL and all these things, you have to make the payment in advance. So whenever you are making payment in advance, then the situation changes, because then in that case, it will be on the payment amount. That is what they have clarified in that particular aspect. So if it is qua bill, then one can always say that VAT amount, because same GST analogy can be brought. Of course, they have used only word GST. They have not referred this VAT concept as such, but typically one can understand that. And if it is qua bill, then yes, without GST. But if it is on payment, then entire amount.
Okay. So the next question is whether section 2061H of TCS will be applicable to builder.
2061H of TCS will be applicable to builder. Well, two arguments can be thought of. One is if I am giving a constructed unit or if I am giving a under construction unit. Now, for under construction unit, one can assume or argue that technically for GST purposes, it's treated as service. So they apply the GST as such. So definitely it is out of the purview. Now, if I'm giving a constructed unit, then the issue arises whether it can be termed as a goods because of flat, whether it can be termed as a goods. And it has been said that yes, sale of goods and transfer of property are two different transactions altogether. So technically, the provisions of 2061H should not be applicable to a builder in such scenario, because services are excluded and the term goods has to be understood in its natural sense. So obviously, a building or construct unit may not be treated as goods. Maybe for goods and GST, it's a different implication, but for income tax purpose, we'll have to see from that perspective.
Regarding the IOCL, Jugal, I think you have one more query. You can unmute yourself, and if you want to ask something, you can ask.
Yes. So, sir, as you told that if there is advance payment, then we have to deduct on the entire amount. But what if there is no advance payment? In that case, what stand should we take?
Yeah, that's what I said. The basic plus VAT is there. So obviously, we have to exclude that VAT and on the basic amount. Because as I said, circular refers to GST specifically. But
Okay.
in original scenario also, this kind of circular was there in earlier scenario also. And we always said that this tax amount or VAT amount is not something which includes embedded the profit element because it directly goes to the government as such. So they have categorically said that you have to exclude that. So no issue.
Okay. Thank you.
So the next query is, if resident Indian is paying rent to non-resident and TDS is more than rupees 50,000 per annum, will provisions of higher TDS be applicable if non-resident has not filed return of last 2 years?
First of all, we'll have to see. Of course, I'm presuming that that non-resident is having PAN number. Because if the PAN number is not there, then as it is rate will be 20% technically.
Yes.
So that is one part. And if he is having PAN number but he has not filed return of last 2 years, then yes, the provisions will apply accordingly. And they have made, I think we are talking about 194 IB. 194 IB, and it refers to any person being individual HUF family other than responsible for paying no, actually, it refers to paying to a resident in any income by way. So, since this is paid to non-resident, then technically speaking, as it is 195 provision will take care of that, and not 194 IA, because 194 IA talks about payment to a resident person. So, definitely this will not apply.
Jigar sir, I have unmuted you in case you want to add something.
Yeah, okay. Actually, any which way we are deducting the TDS under section 195 and at the rate of 30% plus whatever is the surcharge and education says. So that is why I just wanted to clarify.
Yes, yes, absolutely. Because it will get
So
covered
in
by
which way we are
195
deducting at a highest rate. So if it doubles, then he will
Yes,
say you vacate
No,
the
but
flat.
that is very clear that two provisions when simultaneously there, even if it is unwritten, still it cannot operate twice, like typically, because that will be
Yeah,
totally injustice.
correct. The non-resident already has the PAN, but he is not filing the return.
Right. So 195 will apply, and he is already contributing to government what is government's due.
Yeah.
There should not be any further deduction.
Yeah. Thanks.
So I think this is the last question. Whether
Yes.
194Q applies to purchase of TDR?
Again, as I said, TDR again is an intangible asset, what we understand, and services is out of that particular scope. So, in my humble opinion, it will not be applicable to TDR cases, first of all.
Okay. Nishan bhai, in case you want to add something.
When in the circular they have referred to certain certificates, say energy saving certificates and other certificates which are also intangible in nature, for which they have given exemptions. However, they have not given exemptions to certificates like a TDR certificate. So whether the same applies or we need to look at.
I agree. One will have to really check. But as far as those certificates are concerned, probably one understand that the reason are totally different. Means why these certificates and even the transactions of security transaction tax where isn't paid, there is recognized stock exchange. So that exclusion is categorically given. So by virtue of the term services, it will have a larger implication that one understand. But again, as I said, they have to come up with a clarification as such, because typically speaking, it refers to, first of all, just a minute. Because it refers to purchase of any goods, and one will have to really see whether it falls into the term of goods. That is the real test, according to me. So even such certificates and all these things, as an abundant precaution, they have clarified that in that particular circular. But typically, it has to fall into the term goods, and that is the crux of it, I believe.
Ishan bhai, I think it's sir has clarified.
Yes, yes. Thank you.
Sir, we are done with the queries.
Yes, Chaitanya.
Is there anything else you would like to take up?
Not really, because we are talking about this amendment part, and I think I have covered exhaustively that. So we can conclude the session.
Okay. So, sir, firstly, thank you very much for taking out time for Pune camp. We always feel that you are a part of Pune camp and very near to us. And whenever we ask you for any session, you readily agree. So, thank you from bottom of our hearts that you always come to Pune camp. And we would like to contribute to the CA Benevolent Fund on behalf of you. And we'll always welcome you, sir. You are always welcome, and we'll again keep calling you to
Yes.
Pune camp.
Yes, Chaitanya. Pleasure is mine. Thank you.
Yes. Thank you once again. Thank you, everyone. And I declare this session to be ended. Thank you.
Thank you.